Hi, everyone. Good afternoon. We'll have our webinar starting very soon. Just giving a couple of minutes for more people to join. Today we'll be addressing some frequently asked questions on buying a property in Portugal. We will address some basic concepts and some not so basic concepts, but basically to put everyone in a sort of level playing field, on the same level playing field regarding this very interesting topic. I'm Roberto Castro Mendonça. I'm a lawyer. I specialize in taxes. I've been doing this all my professional life. And today, Angela Figueira, which is our head of real estate, is also joining us. Angela will do a quick outlook and gives an overview of the real estate markets in Portugal as it stands. Angela, please.
Hello, everyone. I'm Angela, and I am the head of the NEWCO Real Estate. I just want to make a quick note of the Portuguese real estate market. So the Portuguese real estate market stands out in Europe for its unique combination of advantages, including competitive prices and welcome environment and relaxed lifestyle. I think investors in Portugal are looking for a mix of security, profitability, and quality of life. The real estate market in Portugal has undergone a period of great growth and transformation in recent years, especially in cities such as Lisbon or Porto, some cities in Algarve, and recently in the city of Funchal, where I am at the moment. I work throughout the Portuguese market, but I'm based on Madeira Island, which, for example, Cority allows short-term rental with some benefits. So it's good for the investor client. In addition, it has a good climate all year, and most of the houses have mountain and sea view, so it's a beautiful island. It has direct flights to many cities such as London, Paris, New York, Prague, Warsaw, many cities in Germany, Madrid, and several daily flights to Lisbon and Oporto. So my contact details will be at the end of the presentation for any information that you may need. Now Roberto will continue with his presentation. Thank you.
Thank you, Angela. That was pretty insightful. So now let's go to the more technical details. Just passing, there's a bit of a delay here. I just inserted some basic considerations about Portugal that most of our attendees today already know, that it's a great gateway to the European Union. We have an investor-friendly climate with some investments that promotes, with some incentives that promote foreign investment, an English-speaking population with a mix of expats. Of course, tourism is also very important for us. So from the very beginning, we are used to speak English and even more than one foreign language. We have, as Angela said, a peaceful country with a low crime rate. Also specific visas, and this is important, of course. In the last few years, Portugal has been a hotspot for immigration. But on this one, I would like to highlight the ones for those that have passive income, like they receive pensions or that they receive dividends and want to live in Portugal, or in case they incorporate a business, they also are entitled to live in Portugal. So Portugal always is keen on attracting new people to live here. And also, Portugal does not make a distinction between the fact that you are living here under residence permit or the fact that you are Portuguese. So you are entitled to residence rights such as education, healthcare, social security, etc. Then, of course, because I'm a tax lawyer, I always put this tax angle. You still have some tax-friendly features. Of course, what we call the NHR 1.0 was canceled last year. Currently, we have a grandfathering regime. NHR 2.0, as I call it, is still requiring regulation. But on the other hand, we have the good regime of crypto taxation, and we do not have inheritance tax when it is the direct line in ascendant or descendant, and we do not have a general wealth tax. So question number one, Does Portugal impose any restrictions in terms of nationality/residence when buying a property? First question. Portugal does not impose any restrictions in this regard. We know, and we have seen in the news, that several countries have included some restrictions when buying real estate. We have the examples of Canada, Denmark, Switzerland, New Zealand. Well, there are many. But in Portugal, we of course we have also some issues with housing. It's a big concern of both the population of the government, but we still do not have any restrictions. So regardless of the fact that you are a Portuguese national, or whether you have a residence permit to live in Portugal or not, you can buy a property here in Portugal. Then one other question that I inserted here, still on number one, is whether you should buy your property personally, so as an individual under your name, or through a company. There are pros and cons of both solutions. I would say that the fact that when you buy on a personal level, and in case you want to effectively live in that property, like it will be your tax residence, it might be better to acquire personally, so as an individual, because you will pay a lower amount of acquisition taxes. Also, you have the simple fact that it's of the simplicity. So when you are buying, and you do not have under your name, you do not have to incorporate a company to keep the accounting of the company, etc., etc. So actually, apart from simple, it might be more cost efficient. And on the personal, on a very important level, it might be easier when it's when you buy under your own name to obtain financing with the banks, if that's the case. On the other hand, well, we always have the eternal question of the personal liability in case you have the shell, let's say, of a company. It's always a bit different. When buying through a company, well, typically I advise this solution when you are pooling a number of investors and you want an efficient vehicle to do so, or something that is relatively straightforward to clarify which portion is of who. I think it's a good option when you have such pool of investors. Although you can buy a property in Portugal, having several for investors on their own name. So and each of the investors has its own share in the property. However, with the company, things might be a bit more straightforward in that regard. Of course, with the company, you have more liability protection. And in terms of some specific tax planning or tax efficiency, whenever you have a company, well, you might be able to deduct more expenses related with the property, of course, subject to corporate income tax rules. The bottom line that I want to leave here is that first you need to see your long-term prospect. So what will you do with the asset? Will you live there? Will you rent it? Will it be for short-term rental? Do you have more investors with you? Do you want to use the company for just one investment, or as a vehicle for several investments? So there is no one size fits all, and actually there it's where we add value. That's where a tax lawyer or a lawyer adds value, is assessing whether for each specific case it would be worth creating a company or not. Then we go to question number two, which is relatively straightforward, one of the easiest of this 10 that we will address. You do not need a Portuguese bank account to acquire a property in Portugal. However, it might be easier to open a bank account in Portugal for several other reasons. For instance, when buying, when paying utility bills, paying the transfer taxes, paying the property taxes every year. Having a Portuguese bank account it's pretty helpful in those cases. So although not mandatory, it's something that I typically advise. Um, Also, one thing, though it's not strictly related with having a Portuguese bank account on your name, one thing that it's important to highlight is to be mindful that in some countries there are restrictions when it comes to transfer funds to outside those countries. So sometimes we have cases of clients that, well, they are acquiring a property of a high value and they need to transfer small portions um, before the deed, and sometimes each day or 1 month before the deed. So just be mindful also of that component and look into the transaction holistically. So, but bottom line, it's not necessary, although I recommend it. Question number 3. Should I sign the promissory purchase and sale agreement or go directly to the final deed? Well, this depends on the type of transaction. So for some transactions, well, signing the promissory purchase and sale agreement, well, it's kind of a no-brainer. For instance, when it's an asset in construction, you will sign the promissory purchase agreement because, well, it's still in construction and you want to be sure that the construction will be finalized, etc., etc. But when it's an asset, well, that's already completely finished, that you feel that it's exactly what you want, that you feel and or that you made the analysis and that, well, you are ready to go to the final deed, it's not an obligation under the Portuguese law to go for a promissory purchase and sale agreement. However, it's still the most frequent route or the most frequent first step of the acquisition. And what? What? Basically because first, when signing the purchase and sale agreement, you do kind of a reservation. So you do a down payment of 10%, of 20%. Well, it's up to then the negotiation. And then the promissory purchase and sale agreement will provide the framework of the transaction. It will give the timeline for the closing. It will provide the obligations of the seller. It will provide the obligations of the buyer, and of course provides also for penalties in case one of the parties does not comply with its obligations. Typically, I really advise from us to sign a promissory purchase and sale agreement, also to give you time to analyze the documents of the property and see if everything is in order for the closing. But it's not mandatory in the Portuguese law. Is it mandatory to be in Portugal for the signing of the final deed? No, it's not mandatory. We have clients that prefer to come themselves to Portugal and be on the day here in front of the notary. In Portugal, typically these are of course made in front of a public notary or a private notary, but you do not need effectively to be in Portugal. Of course, in case you're not, you need to provide a power of attorney, granting powers to someone, to your lawyer, well, to whoever you deem fit, to represent you on the final deed. Just be mindful that it cannot be, of course, a blank or almost blank sheet of paper. You need to, in case you are in a country that follows the Hague Convention, to have the document apostilled, recognized in front of a notary or a lawyer, etc., in order to, on the day of the deed, the notary, the Portuguese notary, check whether the powers have been granted sufficiently and officially to the person that will sign the deed on your behalf. Because of the fact that most of our clients or many of our clients do not live in Portugal, at least at the moment, on the moment of the signing of the deed, it's very usual for us to represent clients on that date. However, it's always a matter of choice, of course, of the buyer. With the seller being, well, the seller cannot refuse to proceed with the deed on the grounds that the buyer is not in person and is represented by someone with the power of attorney. So the closing will go ahead in any way. In which cases should I do a legal and tax due diligence of the property? So this is question number 5. So already halfway through our questions, but we will have some more that will be more dense. So it's good to be a bit of ahead of schedule. Well, it's always important to do this. From a tax perspective, for instance, in case the previous owner does not pay the property taxes, let's imagine a scenario where he has not paid taxes for 5 years, for 10 years. Well, of course, this is an hypothetical scenario. There is a provision on the Portuguese Civil Code under which the property responds or is an asset that responds before the public state as a guarantor of the payment of the taxes. What does this mean in practical terms? So the state can ultimately confiscate the property to secure the payment of the property taxes. This is something that is provided by the civil code. It's not properly a tax code, but it's possible. So what we do typically on these tax and legal due diligences is to check, well, it's to do an X-ray of the property or even a CIT scan. So basically we check whether the property taxes were paid, the transfer taxes, how they were paid, and if they were paid, the condominium, if they have been paying or not. Even if everything from in terms of licenses were obtained, and if the licenses are still valid. So let's imagine a scenario where the seller would build something illegal on the land of the property you're acquiring. It's something that we check. We also check how and if there are mortgages on the property. So we basically prepare or pave the way for everything to be ready for the final deed. Without this assistance, and of course, none of this is mandatory, but without this assistance, you expose yourself to risks. And when there is risk, particularly when we are speaking of a tangible asset such as a property, when you are speaking of also a foreign investor that is moving to Portugal, of course, it's something that we should be adverse. So my advice is always, well, it might increase the cost of the transaction, but doing a legal and tax due diligence will mitigate risk and will ensure that first, the property is in a good position for you to acquire, and then down the road, the property is in a good position for you to sell. So when you sell your property, also the new buyer, in case he's well advised, he will also ask you for the whole history or the whole background of the property. So having these good practices will ensure that you mitigate risks now and to the future. Very good question. It's a very frequent question is how you calculate and pay the real estate transfer tax, in Portuguese IMT, and the stamp duty. Let's start with the IMT. These taxes are typically paid, well, one business day or even on the very same day of the deed. We obtain the liquidation statements either online or by going to the tax authorities, and they must be paid typically through a Portuguese bank account because the reference is not. It's a specific bank reference that foreign bank accounts cannot use. But they are paid right before the deed, preferentially because, well, you never know. In case you pay it like 3 or 4 days before, and then the closing does not happen, then it can be a bit painful to claim the real estate transfer tax back and the stamp duty. Of course, you will get it back, but it will be, of course, a bit time consuming. So we typically advise to pay these taxes on the same day or the day before. The taxes change quite a bit depending on the use that you give it. Here I inserted the rates that apply to an acquisition that will be of a property that will be your permanent place of residence. So basically your tax address. You can see that the IMT rates are progressive. So up to 101,000 euros, you do not pay IMT. But of course, these values, are not within the market standards nowadays, with few exceptions. And then you have the progressive rates that with the last bracket being above 1.1 million euros. There are limited exemptions on IMT, one of them being urban rehabilitation. Most of the exemptions are pretty complex, so I advise you to check with your tax lawyer whether it would apply to your transactions. There are sometimes clients that come to me thinking that they will be exempt on IMT acquisition or that will be able to claim back IMT. And then, unfortunately, when you delve into it, you find out that you are not exempt. So just be mindful that the exemptions are pretty limited. For other types of assets, so assets that are not exclusively for use as a permanent residence, different rates apply. I can give you several examples. So for rural properties, it's a 5% fixed rate. Plots for construction, it's a 6.5 fixed rate. Or a commercial property, for instance, a store, it's a 6.5% rate too. Just be mindful one thing here. It's not too frequent, but it happens. Whenever a company resident in the Portuguese on the blacklisted jurisdiction under the Portuguese legislation, whenever such company wants to buy a property in Portugal, an aggravated rate of 10% applies. Why am I mentioning this? It's because Portugal has a huge list of blacklisted jurisdictions. You can Google them. You can simply Google Portugal list of tax havens, for instance, and you'll find out that there are more than 50. And whenever an entity resident in this jurisdiction is buying a property in Portugal, you pay an aggravated rate of IMT of 10%. So it's really a hit that you take from a tax perspective. On the IME, going back, the stamp duty is 0.8% always. So you pay both real estate transfer tax and the stamp duty. And then we have the property taxes. What is the difference of these property taxes with the real estate transfer taxes? Well, it's, as the name says, the real estate transfer taxes are paid only when you acquire the property. This one, the IME and potentially the IIME, you pay during the time or the time frame that you hold the property. So every year, typically in 3 installments in May, August, and November, you'll pay this IME. But there is one important thing, is that the IME with rates ranging from 0.3 to 0.45 is payable over the tax value. The tax value is not the market value. Actually, it's typically a lot lower than the market value. It's difficult to estimate, but around maybe 2/5 of the market value. And it's calculated with a complex formula used by tax authorities. And it takes into account the location of the property, the size, the condition, and really does not reflect the current market fluctuations. But still, it's a tax that is due, the IME. And the rates, why is this? There is a range from 0.3 to 0.45. It's basically because the IME is a municipal tax. So the municipalities can apply the rate that they deem fit with under this range, because the IME being a municipal tax, it will be a municipal not income, but a municipal tax that will be paid to the municipality. So the municipalities have this right to define the rate. Once again, properties owned by companies resident in tax havens, just look at the rates, 7.5% rate over the tax value. It's completely huge, so a huge jump. So definitely it's not a good idea to buy a property in Portugal whenever it's through a company in a tax haven. Then you have the IME. So there are some scholars that call the IME as being a wealth tax. I do not think it's, well, it's not a wealth tax per se, in my opinion. But it's a tax that is paid to that is payable by those that have properties of a high value. So basically what you do is for each person, you register the value of the urban properties that that person has, but the tax value. And in case the tax value, when it's a single person, exceeds 600,000 euros, you pay the IME at a rate of 0.7%. Whenever it's a couple, the sum of the properties must be around 1.2 million. So we have a relevant deduction for the payment of the IME, but it's still a tax that is paid, particularly by those that have either a property of a high value or a sum of properties that give somehow a high value. So at the end of the day, it indeed taxes wealth in the sense that the more that you have, the more in terms of real estate, the more you will pay. But still, and again, it's over the tax value and not the market value. Of course, if it was over the market value, it would be it would have an application that would be a lot more higher and broader. Again, I just inserted 7.5% for properties owned by entities residents in tax havens. Number 7, I have a property in Portugal and I want to sell it. How do I calculate my tax burden? This has been a good old question over the years. In the past, Portugal would make a distinction whether you were a resident individual or a non-resident individual. In the meantime, Portugal, there were challenges to the Portuguese legislation in the European Court of Justice, and these challenges led to two judgments from the Court of Justice that considered that the Portuguese legislation in this regard was contrary to the European Union law. So now, either you are a resident of Portugal or a non-tax resident of Portugal, the way of computing your tax burden when selling a property is exactly the same. And what will happen? When you sell it, the gain will be taxed at progressive rates. The progressive rates in Portugal go up to 48%. However, only 50% of the gain will be taxed. Practical example, 300,000 euros of gain, only 150,000 euros are taxed. The other ones are exempt. However, the portion that is taxed is subject to progressive tax rates that in Portugal, as I said, go up to 48% for income above roughly 81,000 euros. So it's actually an effective rate that can be still below 20%. It goes around that, but it's now it's harmonized in terms of being resident or non-resident. Of course, when calculating the capital gain, you will be able to add expenses, for instance, on the improvement of the property. Note that expenses on the maintenance of the property cannot be used as per the Portuguese tax authorities for reducing the capital gain. So only the improvement, so the works that you do that improve the value of the property, so you build a pool, for instance, are considered to reduce the capital gain. And also, whenever the property is your tax residence, we have a rollover regime. What is the rollover regime? Basically, capital gains so proceeds from the sale of your permanent residence, not the gain, the proceeds, are exempt to the extent you reinvest them in the acquisition of a new property for your permanent residence in Portugal or on the European Union. So as from the moment you sell your property, your Portuguese property, you have 36 months to reinvest the proceeds of that sale. In case you effectively uh, reinvest the proceeds, well, you will not be taxed over that amount. One thing that is important and that recently changed is that to use this rollover mechanism, the property that you are selling must have been your tax residence for the past 12 months. This changed 2 times in the last year. So in October, it was mandatory to have it was introduced a provision whereby it was mandatory to have the property as your tax residence over the last 24 months. But then it was changed again 2 months ago, and now it must have been your tax residence for 12 months before the sale. This is, of course, as you understood, when you are selling the house that you own as an individual. So you do not own it through a company. Whenever you sell it, when you own a property through a Portuguese company, well, whenever you sell it, it will be a gain in the hands of the company, and it will be taxed according to the corporate income tax rates that apply. For instance, in mainland Portugal, we have the 21% standard CIT rate. In Madeira, we have the 14.7 CIT rate. So in Madeira, actually, the rate is lower. So you will have a lower taxation in that regard. Do I need a tax representative in Portugal in case I buy a property? This is a pretty old discussion. Portugal 20 years ago would ask for a tax representative to everyone, even for EU residents that had a taxpayer number here in Portugal. So it was really kind of abusive, I would say. The legislation has been amended since in a way to mitigate or to eliminate, in some cases, the needs of having a tax representative. So the government basically saw, and well, I believe, that the tax representative could, in some cases, represent a cost to the taxpayers that was sometimes useless. So now the tax representative is mandatory only in case the taxpayer does not subscribe what they call a dematerialized notification channel that is certified by the tax authorities. So you have two options. You either choose this to be notified digitally, let's say through a dematerialized channel, or you appoint a tax representative. Having said this, and although this might seem opposite to what I said, I always advise my clients to appoint a tax representative. Why? Well, basically because a tax representative, whenever you do not have a VAT activity in Portugal, so you are just the owner of a property, the tax representative is only, let's say, someone that represents you, or that it's a connection between you and the tax authority. So the tax representative will not be liable for paying property taxes. He will just be the person that receives the liquidation of property taxes and delivers them to you. So he will ensure that communications from the tax authorities are well received. My experience tells that clients that go for the materialized options sometimes miss important notifications, either because they do not check their mailboxes, or that they are not familiarized with the systems that the tax authorities use, or because it's in Portuguese, whatever. My experience tells that having a tax representative will mitigate the risk of losing deadlines and having any sort of issue for missing those deadlines. So at the end of the day, it's not mandatory. Nowadays, even less, but I still recommend it. Should I put my property on long-term or short-term rental? Question number 9. We are kind of going a bit back and forth in terms of themes, but this is something that I did on purpose, basically not to overwhelm you with much information. Let me just a quick break. As any good lawyer would say, the answer to this question depends, because it's really tricky to tell. Let's start by the long term because it's more plain vanilla. As you know, in the European Union and in Portugal specifically, there is a housing crisis, and the short-term rental has been the short-term rental has been seen as kind of the scapegoat for this crisis. For this reason, the government, the past government, not the one that is in functions, opted to create a package to foster a long-term rental. There were plenty of measures such as incentives to move your property from short-term rental to long-term rental. For instance, until the end of this year, in case you have your property in the short-term rental, like Airbnb, and you move it to long-term rental, you are exempt from personal income tax on your rental income for 5 years. So there were several incentives, and one for the long run was exactly lowering the personal income tax rates that apply to the residential rental. So anyone with a property renting such property under a rental contract with a duration of 1 to 5 years will pay personal income tax in Portugal at a rate of 25%. In case the rental agreement has a duration of 5 to 10 years, the personal income tax rate lowers to 15%, so less 10%. I believe this is a decent range to move with. So signing a rental agreement with 5 years, 6 years, it's something that can be in the future kind of market practice, and 15% rate of a rental income is still quite competitive. And you have then further reductions, but over extensions that might be more difficult to see in the common world, let's say. So in case the rental agreement is signed immediately with a duration of 10 to 20 years, the personal income tax rate is of 10%. And in case of rental contract signed foreseeing a duration of more than 20 years, there is a 5% personal income tax rate applicable to it. So the higher the duration of the contract, the lower you will pay on personal income tax. So 20%, then goes to 15%, then goes to 10%, and then goes to 5%. We'll see how the market responds to this. But still, it's just a reduction that tries to put people on the side of the long term and not so much on the side of the short term rental. We'll see. On the side of the short term, and starting here with a side note, you probably heard that the government was planning to introduce a short term contribution, some kind of sort of a surtax over short term rental. This plan has since been abandoned, so there will be no longer that extraordinary contribution. For those that do not know what am I speaking of, you can check our blog in our website where we wrote about it. So there will not be that burden over the short-term rental income. Also, the computation of personal income tax due on short rental income is a bit complex. You have basically a standard regime and an optional regime. The standard regime would be to frame it under category B, with category B, it's like business income. You are like a private entrepreneur. So you are deemed as having an activity of short-term rental. In case you have an annual income below 200,000 euros, you will be subject to progressive PIT rates, true, up to 48%, but under the simplified accounting regime, only 35% of the income will be taxed. The remaining 65% will be deemed as expenses um, and will not be taxed. Although of those 65%, you have 15% that you must justify through invoices, expenses, etc. So at the end of the day, we have a regime whereby only 35% of the income is taxed, and so it's pretty competitive. Just note that these 35% that are taxed increases to 50% whenever you are in what we call the urban contention areas. They're not too much urban contention areas. Actually, it's mainly in the center of Lisbon and Porto. They can easily be found online. But what government did was, whenever you are in this urban contention area, you pay more tax in the form of personal income tax than whenever you are not in this urban contention area. So bottom line, uh, this simplified regime is pretty interesting to those that do not have expenses that are below the amount that is automatically considered expenses by using the simplified accounting regime. It's of course a bit complex. That's why I'm here for. In case, of course, there are any questions in this regard, I'm happy to clarify afterwards. You have also the option, in case you do not go for this simplified accounting thing, of going through the option of taxing it as real estate income. You are able to deduct some expenses like condominium charges, insurances, etc. And you can opt for the 20% rate or progressive rates. 20% rates, of course, is typically the most used because most people uh, with properties using on the short-term rental have an amount of annual income that falls above the amount of income that over which the 28% progressive rate applies. So basically, opting for the 28% flat rate will be more tax efficient. At the end of the day, it's a matter of weighing the pros and cons, simulating also um, what is your business plan, what do you expect to earn, which expenses you believe you will have. Also, because in case you have much expenses, it might be worth considering incorporating a company to be able to deduct them throughout the following years, etc. So it's really a tricky question. It's a subject where a careful analysis might bring you a lot of benefits in the future in the form of tax saving, and of course in the form of simply having being sure that you are choosing wisely and that you are allocating the right forms of taxation to your income. Then one recent question. So for the ones that are not familiarized, Portugal introduced recently a regime of exemption to certain acquisitions made by individuals below 35 years old, below or with 35 years old. And plenty of people have asked me, well, I'm not a Portuguese citizen. Am I eligible for it? And the answer is yes. Portugal does not make a distinction simply on the ground of nationality. However, there are several conditions for this transfer tax exemption that I outline here. So it must be your first acquisition of an urban plot or urban property building intended for, and it should be intended for your permanent habitation. So it must be your tax address. You must not have been an owner of Portuguese citizen property for the past 3 years. And then you have, well, the exemption does not apply regardless of the amount of the transaction. So basically, for transactions up to 316,000 euros, there is a full exemption. Then you have a bracket of 316 to 633, where you have a marginal rate of 8% that applies only to this portion. And then in case, well, you are buying a property above 630,000 euros, well, there is no benefit at all. Um, so you have first to calibrate whether you fulfill the access criteria to the regime, and then whether the transaction has an amount or a value that allows you to benefit from this real estate transfer tax exemption for those that are 35 years old or under. So at the end of the day, seems like an interesting measure, but be careful with the details. As always, the devil is the details. So it's something that is really necessary to analyze. One thing that is also a bit tricky is that the part of you must allocate the property to your tax residence within 6 months. That's generally fine, but you cannot give any other use to the property for 6 years. Of course, life changes quite a lot, and 6 years seems a bit heavy to those that benefit from this. Of course, I'm not here to comment on tax fairness, but it might be detrimental of the regime. However, there are some safeguards. For instance, in case you change the employment to a certain distance of the property, etc., that apply. So you will not end up stuck for 6 years in every case, but you might end up stuck in case you do not fall under one of the safeguards that allow you to give other use to the property. And what is other use to the property? Well, simply renting it out to another person. Also for stamp duty is there is a partial exemption for those on 35 years old or less. So at the end of the day, you have an interesting feature that was introduced by the government. Other tax benefits might be on the pipeline for those that are 35 years old or below, notably on personal income tax, but that is still uncertain and it's still under negotiation, and we'll see what is the outcome. What is a reality as of today is this transfer tax exemption subject to these conditions, but that, depending on your case, might apply. Well, reaching the end of this journey. Again, thanks to everyone. Just a bit of NEWCO. Of course, everyone on this call probably receives our newsletter, our communications. So we are a team of multidisciplinary team. Difficult word to say after so many minutes speaking. We have a know-how of more than 30 years in the business. You have a team of accountants, tax lawyers, such as myself, Angela, our real estate consultant, another specialist in promoting and implementing, above all, implementing investments in Portugal. So just feel free to reach out, and we'll be happy to have a discussion with you and see how and if we can help. And well, we are happy to assist. Thanks to everyone for being with us today. There will not be Q&A moments, not a dictatorial regime, but we felt that it was a good way of kind of controlling the time or the duration of the webinar. Hopefully there will be more in the future, and I look forward to seeing you all in those events. Thanks, everyone.